With so much happening across real estate at the moment, we know that COVID's really impacted the real estate market here in Australia. So I thought it'd be really cool to see, as part of the research CoreLogic has conducted, what the difference between 2020 is and 2021 is in relation to the COVID impacts on the real estate market. If you're interested, keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now for me, as you guys already know, I've got over 120 videos on this channel. So if you find any value here, drop a like for the video, share the video with someone that needs this education, and of course, watch a couple more because why not? Now before we jump into this, I just want a quick reminder for you guys. I have the online course, Confusion to Clarity, which is a link in the description below for you to get started in real estate. I know it's not always possible to come here and watch all these videos, get educated around, different aspects of how to buy, where to buy, things like that. So there is a course that I've specifically created for this. It's called Confusion to Clarity. Definitely go check it out. It's in the link in the description below. According to CoreLogic's latest property pulse, a number of housing indicators, many Australian regions have proved more resilient this year than last, despite Head of Research Eliza Owen conceding that not all pockets of housing market remain robust. The question remains, are we faring better in 2021 than we were in 2020? Ms. Owen shared the indicators of the housing market performance that have seen dramatic changes over the past 18 months.
Let's have a look.
Number one, consumer sentiment see shallower decline. Based on figures from ANZ Roy Morgan, consumer sentiment declined 40.1% through early 2020 during the first lockdown that lasted 6 weeks. In contrast, the current wave of lockdowns has so far seen a peak to trough fall in consumer sentiment over the last several weeks with a decline of 12.3%. So 40.1% versus a decline of 12.3% in 2021. Now, keep in mind, obviously, the sentiment was always lower in 2021 than it was in 2020 when it started, but that was because we already had gone through lockdowns. We understood what COVID was and what the lockdowns actually meant. According to Ms. Owen, consumer confidence has been more resilient now that given more information about the economic impact of the lockdowns and importantly, the strong recovery trend that followed stage 2 of restrictions last year. Interestingly, the ANZ Roy Morgan Index seemed to have stabilized above 100, which indicates more people are providing favorable answers to questions around economic and financial conditions. Number 2, sales activity continues to decline, but not as much as last year. Stage 2 restrictions in 2020 saw national housing sales drop in volume by 33.9% through April, including a fall of 36.7% in Sydney and 40.3% in Melbourne. This was largely attributed to restrictions that made transactions harder to carry out, as well as low levels of consumer confidence and high percentage of job losses, Ms. Owen said. The last time around, despite the continued presence of social distancing restrictions, other factors have made for a more conducive environment for sales, including higher household savings, lower interest rates, and improving job sector, she explained. Now, I totally agree with this. I think the bigger difference is that we had like a broad lockdown. People didn't know what was happening. Even I didn't know what was happening to a certain extent with the health side of things. But I always knew that if the government was going to support real estate and the real estate industry through a time of such uncertainty with, mortgage repayment pauses, you got JobSaver, JobKeeper, all of those things were coming in. If you were going to see that during a time where there was the maximum amount of uncertainty, then you knew that moving past this, they were always going to support real estate. Now, in what sort of capacity was always going to change, but you knew, when you sort of sit there and go,
if I invest now, Ravi, what's the worst case?
The worst case was going to be, your tenants leave or things like that. It was never on the plan that you would have COVID where the lockdowns occurred and everything gets shut down. That's like worst of the worst, beyond the scale. And that happened, but property prices went up. So that should be the biggest bullish indicator for a lot of people, knowing that we are in the next leg up for the real estate cycle. Fall in stock has been milder. The decline in newly advertised stock has also been more subdued in 2021, with about 1,350 properties added to the Sydney market for the week ending 29th of August, just 23% lower than the 5-year average pre-COVID. Assuming new listing volumes continue to climb, this marks a peak to trough decline of 37.5% of new listings added to the market since the onset of Sydney lockdowns, compared to a peak trough decline of 52.4% through restrictions in early 2020, Ms. Owen explained. Melbourne, in comparison, recorded a steeper decline in new listings since August, but the Victorian capital has also seen more volatility because lockdowns have been more frequent. On average, weekly new listings across Melbourne have actually been higher than in Sydney and are higher than the average weekly listings added across Melbourne through 2020. 2020. Again, we're trying to focus on two, big generic markets being Melbourne and Sydney. There's no mention of your Brisbanes, your Canberras, your Adelaides, and there's definitely no mention of the regionals. So this is very interesting to see what are the bigger economies doing and how that's coming across into the rest of the state and rest of Australia. Number 4, Sydney and Melbourne auction results are diverging. Despite being in lockdown since June, Sydney auctions result had remained high, clearance rates averaging 75.9% through late August and volume of properties clearing 474 per week, the highest average weekly auction sales for the period since 2015. So it's interesting, we're getting the lowest amount in terms of how much stock is available, but then you've also got high auction results, which is telling you that a lot of people, there's a lot of demand, right? People are frustrated and the actual economy is actually diverging, right? So you've got on one front where people are losing business, they can't be open, people are losing jobs, they have a lack of income, they've reduced incomes, but then on the flip side, you've got other industries that are pumping, and they're pumping, the owners are happy, the people are making more money, they're getting promoted in their jobs because the demand through the roof. What's happening is the people from this area, right, they're coming in and buying up real estate. The people that don't want to sell don't have to sell. And so that's where we're seeing a disconnect. We're seeing increase in demand, and especially from 2020 to 2021, we've seen that increase in demand. I don't think that's stopping. I think that's going to increase. But as more confidence comes into the market, I think we see people start moving around a little bit more too. So I think the supply will increase, but I still think the demand is going to increase and far outpace what's coming onto the market. According to Miss Owen, a low clearance rate across Melbourne could be attributed to the high withdrawal rates across high volumes of scheduled auctions. From the 5th to the 22nd of August, it is estimated around a third of the properties scheduled to go to auction have been withdrawn, which means the auction has essentially been cancelled rather than postponed. The property may be listed instead by a private treaty or not be sold, she said. So essentially, something to learn here is when an auction is placed, right, they've come up with the time, they may withdraw it if they didn't get enough interest, which is what I think's been happening. And that looks a lot better for the agent anyway, because they're going to go, well, it didn't get passed through on auction, we didn't have demand. They've gone, hey, you know what? No one's going to rock up on the weekend. Let's take it off the market and now let's pursue just a private normal sale online and, pursue it that way rather than having the auction and then no one really rocking up. It's important not to dismiss the portion of auctions withdrawn as merely distorting the clearance rates, because it does reflect a loss in demand and vendor confidence. But looking at just the number of properties sold at auction each week, Melbourne still stands strong, recording a higher number of successful results than Sydney for 8 of the past 9 weeks. Varying impact. While the general consensus appears more positive, Miss Owen has highlighted not every pocket of the property market will be impacted in the same way as lockdowns continue to be extended. I definitely agree with this, and we need to step away from looking at markets generally. I get emails still to this day where people are going, oh, well, Sydney prices went up. You put up a post saying that, Sydney prices went up, but my property didn't go up, but my property is in Sydney. And so we see a disconnect of, certain areas growing more than others, and that's how we need to become a lot smarter when we approach these things. When we start looking at interest rates go up, or we see one bank increases their interest rates, or we see growth in property markets, in Perth or in Western Australia, that doesn't reflect the rest of the market. Same thing, interest rates from a bank doesn't reflect how the rest of the banks are looking at this. So we need to go, okay, that's my prompt to now dig deeper. What am I looking at here? Why are certain banks doing something, but then other banks are actually decreasing interest rates, which is exactly happening? Why is that? And you need to ask those questions. If you're interested in sort of daily updates around, stuff we talk about here, more research, then definitely go check out the Patreon, join that. That's where I'm talking to everyone, daily discussions, but also there are perks to being in the Patreon community. Like when I release strategy sessions, they find out first. And that's why they get booked out so quickly, because they're getting the first run at it. They're the most serious about it. So if you're interested in being in a collective cohort or environment where you're talking about these things and having them discussions about finance, cryptocurrency, NFTs, financial freedom and real estate, definitely consider joining the Patreon community. According to her, a diversity of population across like Sydney and Melbourne appears impact on consumer confidence is not entirely uniform. For example, about a third of the employed Australian workforce was working from home in the second half of 2020. Across particular industries such as financial and insurance services, information, media and telecommunications, professional, scientific and technical services, and rental, hiring and real estate services, an average of 5 or more days of work has been conducted from home. However, industries such as food and accommodation have not seen workers largely unable to conduct work from home, but are more likely to have lost work through the lockdown period. So exactly what I'm saying is there's been a disconnect between the economy. So some people are like, I'm struggling to even stay afloat. Like, I don't have enough money for next week's rent. But then there's others going, I've got so much cash. I need to blow this cash. Like, let me use it and buy something. and that's why they're coming into, say, things like real estate, buying shares, ETFs, and maybe they're buying some Pokemon cards because we all love Pokemon cards. The data does highlight that geographical differences in the extent to which remote work can be conducted through lockdowns, which could see varied performance in different housing markets. This is where a huge prompt goes towards finding out what's happening in regional centers. We get so much conversation around, on mainstream media around capital cities. Now, personally, it's not about me hating on capital cities. I think we need to clear that up. I personally live in Sydney and I would love to live here for the rest of my life. I have no interest in having an acreage and having a farm and living regionally. I don't like that pace. It's not me. But when I'm investing, it's purely a numbers game. I'm not interested about my emotions. The market does not care what I like and don't like. That's the game, right? So we need to understand, where is the market moving? Where are the best returns? And how am I supposed to do that while still maintaining happiness, balance, and lifestyle, which is everything that I value and talk about on this channel. If you're someone that wants to invest and, put everything you have and never sell anything, then I'm probably not the right person to be listening to. I like to approach things in a more balanced approach, where if we can diversify, awesome, let's diversify. If that means I get to buy one property and instead of, really pushing for the second one, I can go on a holiday, go on a holiday. You can have best of both worlds, but you just need to be a lot more logical when you purchase property or any asset for that matter, versus being emotional, which is what I believe 99% of people do, and is why they live the 99% of life, which is not financial freedom and just struggling through to get to pension and relying on the pension and your super. We don't want to live like that. That's why you're here. If you're new here, subscribe to the channel and go and watch the array of videos that I have on this channel. I'll catch you guys in the next one. Thanks, guys.